So if you're looking into life insurance, you're probably coming up against the two major pieces of life insurance. We have the term life and then the whole life. And there's a couple benefits and differences and some negatives to each of these that we want to discuss in today's conversation. We're going to go over the four main pieces that you're going to need to know to make the best decision for you. The first piece that we're going to talk about is going to be the duration, the length of the policy that you can purchase with either of these. The second piece that we're going to go over is going to be the features. What do each of these offer that the other doesn't? The third is the cost, which is your out-pocket cost. So how much are either of these options going to run you on a month-to-month basis? And then the fourth piece is the benefits. Essentially, we're going to help you decide which one is going to be the best one for your situation. Hi, I'm Mark with Wealthy Millionaire, and let's dive right into this. Now, if you're new to the channel, don't forget to like, subscribe, share this with anyone that you think would get really good value, but more importantly, let us know in the comments below what your thoughts are, what your comparisons are, and what options that you're leaning towards. If the video is helpful, give it a thumbs up, but let's dive right in. So term, we're going to first talk about the duration. And the term typically starts at a 5-year period. You can do in increments of 10, which is the most common. So we have 10, 20, 30, and it just continues. You can essentially purchase the term insurance for as many years as you want. Now, why would I want to buy more of it up front? It's because with life insurance, your age is the biggest determining factor in the price. The older you get, you're going to pay more of a cost because your health does play a major factor, whether you're 30 or 40. When you get to those ages up and above, you're going to have a higher cost due to the possibilities or the risk of your health going or declining. Now, we're covering this as a death benefit policy. The actual point of the life policy is if you do have the unfortunate event where you do die, and this happens, we want to leave your beneficiaries some income. And in this case, you can do different levels. You can do 250, you can do 500, you can get in the millions. But in this case, we're just going to talk about a $500,000 policy. The duration with the whole life policy is not going to be anywhere near this. This is what we call an unlimited, or it doesn't expire. I'm going to put a little asterisk next to this because it technically with some companies, you've got to be a little bit careful that if you hit 100, you have the ability of that actually expiring at age 100. So they say it doesn't, and the reason it doesn't is because you can actually purchase in addition to the 100 years. So if you're at 100 and you determine, I still want to have life insurance to leave my family, I haven't maxed myself out, so I'm going to turn around and increase the length of that for another 10 years or 20 years or whatever the case is at the time. So you don't have it expire, although it technically in some cases does at age 100. Diving into the policy features, there's a lot of differences between these. So we've got the features of a term life is there really are none. You are essentially purchasing, think of it as car insurance. You're purchasing the $500,000 for a monthly fee. And what you're getting back is if you do perish or die, you're going to get that $500,000 sent to the beneficiaries, family member, whoever the case is, you're going to have that. There's no actual major benefit to having this. There's no features in the term life policy. You're not getting cash back. You're not getting any benefit except for you're going to have that $500,000 in this scenario in case you die. That would go to your beneficiaries, and they have that, and you're leaving your loved ones that income so that they can pay the bills or survive or get past any financial trouble that you may have left behind. Now, the whole life policy has a lot of benefits. This is essentially for someone that's a little bit savvier that wants to have an investment start, but what the whole life does is it's actually going to increase and give you interest on your policy. So as you put money in, you're going to pay more in this scenario, but as you put money in, it's going to turn around and invest that into the market. For example, let's say we put in $500 a month. What they're going to do is they're going to take that 500 and they're going to invest that into a market. Now, there's a top and a bottom. So here's the things that you need to know about this is there's a bottom piece. So if you, let's say, invest this $500 and it's going in every month, another month, another month, and you start to build up a residual in there. What's happening is they're investing that. There's a $0 floor in most cases. And what that does is that protects you in the event that they have bad investments. Let's say they are actually negative 3% on their investment. Well, you don't lose the money that you've put in because they've created a $0 floor. They have the same thing at the top piece. So if we go to the top, they may have an 8% top. So if they end up making 13% or more on the revenue, you don't get this extra piece. Okay, you're going to have a max at the 8%, a floor at the 0. So there's a win and a lose. The lose is you don't get the higher extra. The win is that you don't go below if it goes negative. The additional benefit, so besides the actual investment, you're actually going to have money that you can take out of this policy. So over here, all you have is the $500,000 that you can claim. The only way to do that is to die, unfortunately, and your loved ones get it. In this scenario, it's investing the money that you're putting in, and so eventually this might get to $700,000. And you'll have that income. You can do one or the other. So if you die, it goes back to the $500,000. If you don't die and you personally take out the money, you're going to net a $200,000 profit. Keep in mind, it's going to take some time. This is over the life of a policy. We're talking 40 to 60 years. There's a few things you should know about this. So when we look at this 8% over here, that's not necessarily exactly what you're going to get out of it, because the way that this insurance policy works is they have several buckets. And these buckets are essentially when you put your $500 in, this is where this money goes. So this you may not see grow as quickly as you want because part of it is going towards the death. So they're going to put part of it towards that term version of the policy to pay out in case that death happens. The other part is the investment, and that's where we're seeing the investment grow here. But there's a third piece, which is fees and costs and extras. So by the end of this process, this is the only downfall to this one, is the actual return on the investment is probably going to be closer to less than 3%. Not amazing, but this is really designed for the person that has the finances. They don't really have an investment going on at the moment, but they also want to have protection. They're doing two things, is they're protecting themselves up to the $500,000 in this case, and they're also investing where they're going to get a 3%, and it could be higher, but in most cases we're just going to say a 3% return. Now, if your money is just sitting in the bank, that makes all the sense in the world. If you're more of the savvy person and you're on our channel and you're researching how to save money on mortgages, how to save on insurance, how to get life insurance, we're going to show you how to do that. But in this case, if you're that type of person, you're saying, well, I'm going to take the money that I don't spend and I'm going to invest that. So how much are you actually saving by going this route versus going this one? In most cases, we have our cost. And the cost for this, we're just going to say for a 20-year-old, that's going to be somewhere around $15 on the low end to $60 on the high end. Depending on your health, how long of a term you buy, the longer out you go, it's going to raise up a little bit. But the further down you go, so if we're 40 and we do this, or we're even 60 and we do this, so now that we're out this far, we're probably looking the 60 to 100 and 100 to 300 a month. And then beyond that, you're looking just a high amount. You can get all the way back up to these 500 amounts. Now, the difference in cost between something like a term life and a whole life, the whole life is just one amount, period. There's no additional cost for that. So to compare the two, the term life, you're going to pay somewhere around $500 to $600. Clearly, the older you get, the more it costs. You can get all the way up for a male in your 40s on up is going to be closer to $1,000 a month. So we'll say $500 to $600 in most cases, and that's per month. You are going to save roughly, depending on the age that you're at, about $300 to $400 per month. If you take those funds, invest them yourself, then you will most likely, assuming that you hit the market and you hit the averages, you can get the 8% back, but you're doing the work. You're the one having to find the investments, taking the risks. In this case, the risk is really low because you're at a zero net. You're not going to lose the money, but you're not going to go over that 8%, in which case it's going to net you about a 3 to 5% return. Also keep in mind, one of the other benefits that we didn't dive into is when you get to this level, you have $200,000 in profit, or essentially you have $700,000 in your account. One of the other features that we didn't go over is that you also can remove that money and you can actually loan yourself your own funds. So just like you would with the 401k, you can take this funds and you can invest it into a business. So if you're not quite ready to do the investment side, and if you go with the whole life policy, you can later on say, you know what, I do want to do improvements on my house. I do want to start a business. I do want to invest in other things. So at this level, you can actually take those amounts out of that policy. In this level, you can do the opposite as well, where you can go 5, 10, 20 years. It's going to be more expensive, but you can convert that into a whole life policy down the road. Our last section is going to be the benefits, and I'm just going to talk straight to you guys. If you are younger, if you're willing to invest, if you're the type that wants to save it and work with your hands to get the best investments that you can, the term life is going to be a really good fit for you. If you're someone that has excess income, if it's sitting in the bank, you don't want your money to sit because it essentially gets bored and leaves. If you're what I call a set it and forget it person, you're going to lean towards the whole life option because you're going to have a lot more options for that money to grow as you figure out what your next steps are. Should that change in the future, you have the option to pull or loan yourself the money if you ever need it as a backup. In the term life, you don't have really any options as far as growing your wealth, but you still have what you bought. You have the $500,000 worth of death benefits. In the unfortunate event that you do die, your beneficiaries are going to get this. Same scenario here, except your money's now working for you. So let me know in the comments below what your thoughts are. Which option are you leaning towards, and which one do you think is going to be the best fit for your lifestyle? I'm Mark with Wealthy Millionaire, and don't forget, the more you save, the more you earn.